In a world being, well, radically reshaped by generative AI, can a global titan like Accenture not only survive, but truly thrive?
That's the big question, isn't it?
Or is its sheer size, its very scale, maybe becoming its biggest challenge? We're about to deep dive into a leading market analysis that suggests Accenture is currently trading at a modest discount, but with some very significant questions lingering that might surprise you.
Hmm.
Welcome back to the deep dive. Today, we're cutting through the noise and diving headfirst into Accenture Playet, ticker ACN, the global technology and consulting behemoth.
Yep, a real giant.
Our central mission today is to figure out with you, is Accenture truly poised to capture the multi-trillion-dollar generative AI opportunity that's unfolding? Or is that very scale, its immense size, actually a hindrance in this, rapidly shifting tech landscape?
It's a fascinating puzzle.
We're pulling insights from a comprehensive Accenture Deep Stock research report dated June 24th, 2025. It uses a reference share price of $284.82, and it pegs its market cap at roughly $178.3 billion. So a big company.
Right. And our deep dive into this report isn't just about reciting facts. It's about helping you extract the most important nuggets of knowledge.
Exactly.
We'll explore Accenture's core business, evaluate its leadership, scrutinize its financials, gauge market sentiment, analyze who owns it, and assess the key risks. The goal is really to understand not just what the report says, but why it truly matters to your understanding of this incredibly influential company, especially right now, as it navigates this whole AI inflection point.
Okay, so to make this as clear and impactful as possible, we've structured our deep dive into two main parts. In part one, we're going to break down the first three critical chapters of the report. First up is chapter one, business understanding.
Getting the fundamentals right.
Then we'll move into chapter two, management evaluation. And finally, we'll do a thorough deep dive into chapter three, financial analysis.
The core numbers.
After that, in part two, we'll shift gears to explore chapter four, market sentiment.
How's the market feeling?
Followed by chapter five, ownership structure. Then chapter six, risk assessment. And we'll wrap it all up with chapter seven, concluding outlook.
Bringing it all together.
All right, let's unpack this by truly understanding who Accenture is and what makes them tick, starting with chapter one, business understanding. So what exactly is Accenture's role in the global economy? I mean, what do they do?
Well, at its core, Accenture is a premier global professional services company. Think of them as the go-to partner for businesses and governments worldwide. They help them build their digital core, optimize operations, accelerate growth, basically navigate this increasingly complex world.
And their scale is just huge, right?
Oh, it's immense.
Yeah.
We're talking about a workforce of around 774,000 people serving clients in over 120 countries. That's almost the population of a small city just dedicated to consulting and tech services.
That's staggering. And how does a company even begin to manage that kind of global footprint? I mean, what are the biggest logistical hurdles and maybe the advantages of being that enormous? More importantly, how do they actually make their money with that kind of scale?
Well, managing that scale is actually part of their expertise, but it definitely presents challenges. We'll probably touch on those later.
Yeah.
As for how they make money, what's fascinating is their dual business model. It creates this powerful synergy.
Okay.
So in fiscal year 2024, consulting accounted for about 51% of their revenue. That's $33.2 billion. This is where they drive those large-scale reinvention projects, especially using tech, data, and AI for digital transformations.
Right, the big strategic stuff.
Exactly. And the other side is managed services.
Mm-hmm.
That was 49% of revenue, so $31.7 billion. This involves long-term contracts where Accenture essentially operates core business processes for clients. Think running IT departments, finance functions, that sort of thing. It provides a really stable recurring revenue base.
And this isn't just two separate income streams, right? The report mentions this flywheel effect.
Yes, that's absolutely crucial.
Managed services embeds them so deeply into client operations that they gain these unique insights, which then kind of naturally feeds into proposals for high-margin consulting projects.
They see the problems firsthand.
And successful consulting implementations. Those often lead right back to new or maybe expanded managed services contracts. It's this self-reinforcing loop. It's not just about revenue, it's a powerful competitive moat that makes it incredibly difficult for clients to even think about switching providers once Accenture is really embedded in there.
Exactly. And that stickiness, as you call it, is reinforced by their incredible geographic diversification. In fiscal 24, 47% of revenues came from the Americas, 35% from EMEA, Europe, Middle East, Africa, and 17% from Asia Pacific. It helps them ride out different economic cycles in different regions.
Makes sense. Their service portfolio seems vast, too. 5 synergistic groups. Can you unpack those a bit?
Sure. You've got strategy and consulting for that high-level C-suite guidance.
Yeah.
Then technology, which the report calls the heart of their offerings that covers everything from cloud and cybersecurity to data, and importantly, cutting-edge AI.
Okay, tech is central.
Then there's operations, which is powered by their proprietary Synops platform. You can think of it like an AI-driven brain that automates and optimizes core business processes for their clients, makes things run smoother, faster.
So AI is baked into operations, too.
Definitely. Then Industry X, where they merge digital tech with engineering and manufacturing, basically transforming how industrial clients operate. And finally, Song, which is their creative and customer experience agency. Think marketing, service design, that whole front-end piece.
Wow. So the key takeaway really is just how broad and integrated their capabilities are. They can tackle almost any client challenge, it seems.
Pretty much.
Yeah.
And their leadership in the IT services market is, well, virtually undisputed. They serve over 75% of the Fortune Global 500, 90 of the Fortune Top 100 companies.
90 out of 100.
Yeah. And what's even more telling, I think, is that their average relationship with one of those top 100 clients lasts more than 10 years. That shows incredibly deep structural relationships. It's a real testament to the value they consistently provide.
They also talk about this 360-degree value framework. What's that about? Is it just marketing speak?
Well, it aims to go beyond just financial gains for clients. It also encompasses helping clients with broader societal impacts, things like inclusion, diversity, reskilling their workforce, meeting sustainability targets. It's meant to be a holistic approach, reflecting how corporate priorities are evolving.
Yeah. ESG and all that. Okay, let's shift focus now to the broader landscape, moving into the industry analysis section of the report. What are the big trends driving growth in IT and software consulting right now?
The market itself is just in a massive growth phase. IT consulting services is projected to exceed $900 billion by 2030. That's a compound annual growth rate, a CAGR, of about 7.4%. So, solid growth.
And the key trends?
Well, they clearly play right into Accenture's strengths. AI integration, especially generative AI, is the most significant driver. Worldwide AI spending is projected to grow at a, frankly, blistering 29% CAGR from 2024 to 2028.
29%.
Yeah, huge. Other critical and kind of intertwined trends include the continued shift to cloud computing, the ever-increasing demand for cybersecurity that's not going away, and the growing focus on sustainability and green IT.
Sounds like a really fertile ground for growth for a company like Accenture. But what about competition? How fragmented is it? Who are the main players they're up against day to day?
The competitive landscape is quite fragmented. You've got primary competitors ranging from other large tech services companies like IBM to Big Four accounting firms, Deloitte, PwC, EY, KPMG, who are all pushing hard into consulting.
Right, the big four are everywhere now.
And then other global consultancies like Capgemini, TCS from India, Infosys as well. It's a crowded field.
That is a lot of players. But here's something interesting the report notes. The commoditization of basic IT services, something you might think would hurt Accenture, might actually strengthen them. How does that work?
Yeah, it's a bit paradoxical, isn't it? But as basic tasks get easier or automated, the complex challenges become even more critical. Things like integrating advanced AI with legacy cloud infrastructure, or managing massive digital transformations securely. For those really tough jobs, clients are driven towards a flight to quality.
Ah, okay.
They prefer a single trusted partner like Accenture to manage the entire life cycle, rather than trying to piece it together with multiple smaller vendors. They want one throat to choke, so to speak.
Makes sense. Less risk for the client.
Precisely. And the global regulatory environment, involving trade policies, data privacy laws like GDPR, cybersecurity mandates that presents both challenges and substantial business opportunities for Accenture. Clients desperately need specialized consulting just to navigate these complexities. Compliance becomes a new revenue stream.
Given all this, it really sounds like there are immense barriers to entry for any new competitor trying to achieve Accenture's kind of scale. It must be incredibly hard to replicate their global network, invest billions in talent, R&D, M&A, and build those decades of C-suite relationships, right?
Absolutely. Those are nearly insurmountable hurdles for any serious challenger looking to compete at their level. It takes decades and billions.
So with that foundation, let's talk about Accenture's core strength, its competitive advantage, or what investors often call its economic moat. Where does Accenture truly shine here, according to the report?
Well, it really starts with their brand strength. They've been ranked #1 in IT services for an astonishing 18 consecutive years. Their brand is valued at something like $40.5 billion.
18 years straight.
Yeah. And this brand equity isn't just, vanity. It's a powerful signal of quality and reliability that attracts and retains those top-tier clients we talked about.
That brand strength is undeniable. But, in a world where new agile tech consultancies seem to pop up constantly, how much does a legacy brand like that truly protect them from disruption? Is it enough?
It certainly acts as a significant buffer, but it's definitely not the only thing protecting them. Their massive global footprint also provides significant cost advantages and economies of scale. They can execute projects really efficiently, optimize resource allocation across the globe, spread fixed costs over a huge revenue base. It's incredibly difficult for smaller competitors to match that efficiency. It makes them highly competitive, especially on those large, complex global deals.
They also create strong network effects and switching costs, don't they? By embedding their services and proprietary platforms like Synops deep into clients' core business
Right,
processes.
they become part of the furniture.
It becomes incredibly complex and costly for clients to even consider switching providers. That 10-year average relationship with top 100 clients really speaks to this stickiness you mentioned earlier. It's hard to rip them out once they're in.
Yes, it's a powerful lock-in effect. And they possess these unique assets and capabilities developed through just relentless investment. Accenture poured, what was it, $1.2 billion into R&D
Hmm.
and a huge $6.6 billion into strategic acquisitions in fiscal year 2024 alone.
6.6 billion on M&A in 1 year.
Yeah, it's aggressive. This investment ensures their capabilities are constantly refreshed, keeping them on the cutting edge, especially in high-growth areas like generative AI. They're essentially buying expertise and innovation to stay ahead of the curve.
And speaking of AI, their recent major organizational restructuring, June 2025, right, into reinvention services. That seems like a huge strategic move to hardwire AI into absolutely every offering. It feels like both a defensive play, maybe against those slowing bookings we heard about, and also a really bold offensive move to capture this next wave of technological growth. They're clearly doubling down, maybe even tripling down on AI.
No question, it's a massive pivot.
Okay. Next up, we dive into Chapter 2, management evaluation. A company is only as strong as its leadership, right? So let's turn our attention to the people steering this massive ship. Who's in charge?
The leadership team is headed by Chair and CEO Julie Sweet. She took the CEO role back in September 2019. She has a pretty strong track record, having previously led their largest market, North America, and she played a key role in shaping their aggressive M&A strategy even before becoming CEO. She's widely recognized as a really influential executive in the tech and consulting industry.
And management's response to generative AI, specifically that big reorg in June 25, it seems decisive. It happened right as bookings were showing signs of slowing down, which clearly signals a proactive pivot, wouldn't you say? This doesn't feel like just cosmetic changes. It seems like a fundamental shift in how Accenture plans to deliver value going forward. But the big question is it enough to really reignite growth?
That is the billion-dollar question, isn't it?
Mm.
We'll have to see how the execution goes. What's also important, though, is their high degree of communication transparency with the investment community. They provide really comprehensive financial disclosures, host regular conference calls. They give investors plenty of insight into their strategic thinking, which is good.
And it's probably worth noting Accenture's ethical reputation, too. The report mentions they've been recognized as one of the world's most ethical companies for an extraordinary 18 consecutive years.
18 years, yeah,
That kind of consistency, it really underscores a deep commitment to ethical conduct, especially in an industry where trust is absolutely paramount.
definitely. Now let's turn to their capital allocation. How do they use their money? Management's philosophy seems disciplined and balanced. The goal is to grow faster than the market while also expanding margins. They plan to do this through both internal investment R&D, training, and inorganic acquisitions. They're trying to walk that tightrope of growth and profitability.
And they truly seem to put their money where their mouth is. In fiscal 2024, they dedicated $2.3 billion to internal investment R&D and training their huge workforce. And they aggressively spent that $6.6 billion on 46 separate deals. The Reserve acquisition was cited as a prime example of their targeted approach, buying specific new capabilities.
And returning capital to shareholders is also clearly a major priority. In FY 2024, Accenture returned $7.8 billion to shareholders. That breaks down into $4.5 billion in share buybacks and $3.2 billion in dividends.
Wow, nearly $8 billion back to shareholders.
And they've kept it up. An additional $1.8 billion in buybacks just in Q3 of fiscal 25. Plus, they just raised their dividend by 15% for fiscal 2025. That marks the sixth consecutive year of dividend growth. That's a strong signal of financial health and confidence for management.
Looking at their 5-year capital allocation trends in the report, you really see this consistent pattern. Solid revenue growth alongside strong free cash flow generation. And that cash flow has fueled both that significant M&A activity and substantial shareholder returns through buybacks and dividends. It paints a picture of a company investing heavily in itself and its shareholders, kind of simultaneously.
Now, here's a critical point, maybe a yellow flag, that really jumped out from the report's analysis. Accenture's return on invested capital, or ROIC,
Right, ROIC. Important metric.
for the trailing 12 months ending May 31st, 2025 was 24%. Now look, 24% is still indicative of a high-quality business, no doubt, but this metric has been in a steady decline. It was up at 29% just 2 years prior.
A 5-point drop. Why is that significant?
Well, this isn't just a number. It poses a direct challenge, or at least a question, to their capital allocation strategy. Is Accenture, despite its strong financial health, effectively buying growth through all that aggressive M&A, maybe at the expense of their return on the capital they're investing?
So paying more for acquisitions, maybe, relative to the profits they generate?
Potentially. Or maybe it just takes time for those acquisitions to really pay off and boost the average return.
Yeah.
It isn't necessarily bad, especially during a transformative period like this AI shift where you need new capabilities fast, but it's the kind of subtle signal, that decline, that a discerning investor really needs to dig into and scrutinize. What's driving that trend?
That's a fascinating point. So if it is about capital efficiency, how does that potentially impact their ability to fund these massive AI transformations moving forward? It sounds like they need to be really careful about the deals they do and how they integrate them.
Precisely. Execution becomes even more critical.
All right, let's get into the nitty-gritty, the numbers. We're moving on now to Chapter 3, Financial Analysis. As of our analysis date, June 21, 2025, Accenture's market capitalization stood at $178.3 billion, with about 626 million shares outstanding.
Okay, so when we look at their revenue growth trends over the past 5 fiscal years, it's definitely a story of a post-pandemic boom, followed by, well, a significant deceleration. Revenue grew an impressive 21.9% back in fiscal 2022,
Huge year.
but then slowed dramatically to just 1.2% growth in fiscal 2024. That's quite a drop. Despite this recent slowdown, though, their 5-year compound annual growth rate, the CAGR, remains a pretty healthy 8.5%. But the market is clearly reacting to that more recent deceleration.
What's truly remarkable, though, as the report highlights, is the stability of their profit margins despite this top-line slowdown. Their gross profit margin was 32.2% for the trailing 12 months. Operating profit margin was 15.4%, and net profit margin was 11.4%.
Very consistent.
Yeah, and the company even guided for a 15.6% operating margin in fiscal 2025. It shows incredibly consistent operational discipline. Even when that revenue growth hits a snag, they know how to manage costs.
They absolutely do. They also demonstrate really strong free cash flow, or FCF, generation. In fiscal 2024 alone, they generated a prodigious $8.62 billion in free cash flow.
Wow.
And they've got an 11% 5-year FCF CAGR. This massive, consistent cash flow is really the engine that underpins their aggressive investment strategy and those significant shareholder return programs we just talked about. It gives them immense financial flexibility.
Their financial stability also seems evident in their earnings consistency. Looking back over a decade, the source material shows this remarkably steady trend of net income growth. It demonstrates durable earnings power across various economic cycles. That's the sign of a very robust, resilient business model.
And their balance sheet is very conservative, host.
Right.
As the report notes, they have a low debt-to-equity ratio of just 0.17, or 17%, and a robust current ratio of 1.48. That indicates strong financial health and the flexibility to meet obligations and fund future growth without taking on excessive leverage. They really are, as the report puts it, a financial fortress.
And the dividend stability and growth, as you mentioned, are impressive. 6 consecutive years of increases, an impressive 13.37% 5-year dividend growth rate, all supported by a moderate payout ratio. It's a very consistent income payer for shareholders who value that.
So, yeah, to put it concisely, their 5-year financial performance shows a company that's Been a growth engine, successfully navigated a slowdown while maintaining stable margins, and consistently generated significant cash flow while returning a lot of capital to shareholders. Pretty strong picture overall.
Okay, now for the crucial part, the valuation analysis. Let's start with relative valuation. Using the price to earnings, or PE ratio, Accenture, at that $284.82 share price, trades at 23.9 times earnings. How does that compare?
Well, this PE of 23.9x is actually a discount compared to Accenture's own 10-year average PE, which is around 26.1x. And it's also a discount to the broader IT consulting and services industry, which typically trades in a range of, say, 27x to 33x earnings.
Interesting. So it's cheaper than its history and cheaper than its peers.
Exactly. And this raises that important question again. Why is the market less willing to pay a premium for Accenture right now? It seems to be a direct reaction to that revenue deceleration we discussed, and probably the uncertainty surrounding their major AI pivot and that recent dip in bookings. The market appears to be saying, show me the growth again. Prove this AI strategy works.
Right. The prove it story. Now, to complement that relative look, we also use intrinsic valuations, specifically discounted cash flow, or DCF analysis. Can you remind us what that is?
Sure. DCF is a fundamental valuation method. You try to determine a company's intrinsic worth, what it's really worth based on its fundamentals, by estimating all of its future free cash flows and then discounting them back to a single present value using an appropriate discount rate.
Yeah.
It's about the underlying value, not just the current market price.
And it's very dependent on assumptions, right?
Hugely dependent. Public DCF models for Accenture, for instance, show a really wide dispersion in estimated values, from as low as $149 to as high as $341 per share. That just highlights how sensitive these models are to the inputs you choose: growth rates, discount rates.
Okay. So for this educational analysis in the report, what assumptions were used?
For this specific analysis, the key assumptions were a 7% free cash flow growth rate for the next 5 years, then tapering down to a 2.5% perpetual growth rate forever after, and an 8.5% discount rate, which represents the weighted average cost of capital, or WACC. These are presented as reasonable, but you have to remember they're still inherently speculative assumptions about the future.
Understood. So based on those specific assumptions, what was the estimated intrinsic value range for Accenture?
Based on those inputs, the estimated intrinsic value range derived from this educational DCF model came out between $310 and $335 per share.
Okay, $310 to $335. So potentially some upside from the $284 price used in the analysis if those assumptions turn out to be reasonably accurate.
Exactly. It suggests potential undervaluation contingent on hitting those future cash flow targets.
All right, now let's move into part 2 of our deep dive, kicking off with chapter 4, market sentiment. What's the pulse of Wall Street on Accenture right now? How are analysts feeling?
Well, Wall Street analysts, broadly speaking, remain optimistic. The consensus rating is generally a buy or even a strong buy, and the average one-year price target among analysts falls somewhere between $355 and $375.
$355 to $375. That suggests, what, 25% to 32% potential upside from that $284 reference price? That's a pretty strong vote of confidence from the professionals.
It is, but
But there's a notable disconnect here, isn't there? While the analysts are bullish long-term, the stock's recent performance leading up to the report date was quite bearish, especially after those booking numbers. So if analysts are so bullish, but the market's reacting negatively to the near-term data, doesn't that feel like a red flag? Maybe analysts are being overly optimistic about the long-term AI story, or perhaps missing something the market sees.
it absolutely highlights that tension between the long-term strategic narrative, the potential of AI, and the near-term operational data, like those slowing bookings. Recent news flow has definitely been mixed. While their Q3 fiscal 2025 earnings actually beat estimates, which should have been good news, that positive was largely overshadowed by the second consecutive quarterly decline in new bookings. They were down 6% year over year. Bookings are a key forward-looking indicator, and that decline caused a sharp drop in the stock price. It clearly indicated continued client caution and a slowdown in demand, at least temporarily.
Okay, looking at other market indicators mentioned, what about short interest? Are people betting heavily against the stock?
Short interest is relatively low, actually. It was running between about 1.05% and 1.4% of the float around the report date. This indicates a lack of really strong bearish conviction among short sellers, despite that negative price momentum. People aren't piling in to bet against it sinking further.
Interesting. And the moving averages?
Well, the price was trading near its 50-day moving average, which was around 307 sellers. That often suggests a period of consolidation where the stock is trying to find its footing after a significant move, in this case, that drop after the earnings report.
Okay, so maybe stabilizing short term, but what about the longer term trend?
The longer-term trend is clearer and more bearish, technically. The share price was significantly below its 200-day moving average, which set up in the $334 to $342 range. Trading below the 200-day is a classic technical indicator suggesting the stock is in a longer-term downtrend.
Got it. Okay, from Market Pulse, let's shift now to Chapter 5. Ownership structure. Who actually owns this giant? Is it mostly institutions, individuals, insiders?
Institutional investors really dominate Accenture's ownership. They hold somewhere between 77% and 79% of the total shares outstanding. The big names are at the top. Vanguard, BlackRock, State Street are the dominant holders. This signals strong credibility among professional money managers, and it means Accenture is a core holding for many large index funds and actively managed funds.
And that kind of blue chip ownership structure, it means the stock is probably heavily influenced by broad market fund flows, right? Which can amplify momentum, causing it to maybe rise or fall more sharply just based on money moving into or out of the market overall. It often moves with the general tide.
That's a very fair point.
Yeah.
It does tend to correlate with broader market movements because it's in so many portfolios.
Yeah.
Now, insider holdings, however, are very low. Less than 1% of total shares are held by executives and directors.
Less than 1%.
Yeah, very small. And what's truly fascinating here, and perhaps a bit concerning if you're bullish, is the pattern of insider transactions mentioned in the report. In the 6 months leading up to the analysis, there were 84 open market sales by insiders, including CEO Julie Sweet and COO John Walsh,
84 sales.
and 0 open market purchases.
0 buys.
Exactly. This pattern of consistent insider selling, especially with absolutely no insiders stepping up to buy the stock even after the price dropped, sends a very different, more cautious signal than those bullish analyst reports we just discussed. It subtly undermines the public bullish narrative. It suggests management might be taking some chips off the table, or perhaps they simply don't see the same immediate upside potential that Wall Street analysts are projecting. For a discerning investor, this contrast between analyst ratings and insider actions is a definite point of tension worth considering.
That's a significant detail, yeah. Definitely sheds some light on potential management sentiment, or at least their actions. Overall, though, ownership is not highly concentrated, right? The top 25 shareholders own less than half the company.
Correct. Less than half. This means control effectively rests primarily with the board of directors and the senior management team, not with a few dominant external shareholders who could dictate strategy.
Okay, now, let's turn our attention to the potential pitfalls and advantages with Chapter 6. Risk assessment. We'll start with a classic SWOT analysis. Strengths, weaknesses, opportunities, threats. Expert. What does the report identify as Accenture's core strengths?
The core strengths are pretty clear, building on what we've discussed. Their unmatched global presence and scale, a premier brand and reputation that really instills client trust, that highly diversified business model spanning different industries and services, and, as we covered, what the report accurately calls a financial fortress, that really strong balance sheet and consistent cash flow generation. Those are huge assets.
But of course, no company is without its challenges. What are the key weaknesses for Accenture highlighted in the analysis?
The report points to several potential weaknesses. One is talent attrition. It's a highly competitive industry, and attracting and retaining skilled tech and consulting professionals is a constant battle. Another is the inherent complexity of managing its vast scale. Being huge can sometimes make it harder to be agile and react quickly.
Makes sense.
There's also acquisition integration risk. With 46 acquisitions in 1 year, making them all work together smoothly and deliver the expected value is a major challenge. And that declining ROIC we talked about might even be an early indicator of some integration struggles.
That's a good connection back.
And finally, some degree of client concentration. While having deep relationships with the top 100 clients is a strength, relying heavily on them also carries risk if 1 or 2 of those major relationships were to sour for some reason.
Okay, those are valid points. Despite those weaknesses, though, the opportunities seem immense, right? Especially with AI.
Oh, they absolutely are. Generative AI and digital transformation represent the single largest opportunity. It's potentially a multi-trillion-dollar wave, and Accenture seems uniquely positioned to help clients navigate it and implement it. That's the core bull case, really.
Beyond AI.
There's also continued potential for expansion in growth markets, places like Asia, Africa, Latin America, where digital adoption might still be accelerating, and continued growth in high-demand service lines that are critical right now, like cybersecurity and ESG consulting.
But opportunities always come with threats. What are the big ones facing Accenture, some of which might be kind of unique to their position at the top?
Yeah, there are significant threats. Intense competition is always present from the Big Four, IBM, Indian outsourcers, niche players. It's relentless. There's also rapid technological obsolescence. The pace of change in tech means they have to innovate constantly just to stay relevant. What's cutting edge today could be legacy tomorrow.
Sure.
Cybersecurity and data breach risk is obviously paramount for a company handling so much sensitive client data. A major breach would be devastating reputationally and financially. And critically, there's this emerging threat of AI disintermediation.
Disintermediation, meaning AI cuts them out.
Exactly. The risk that increasingly powerful AI tools, maybe even embedded in standard software suites, might allow clients to perform certain analysis, optimization, or even coding tasks in-house that they previously hired Accenture for. That's the existential question, isn't it?
Yeah.
If a client can just, download an AI plugin or use a built-in AI feature to do something Accenture used to charge millions for, that's a direct threat to parts of their core business model.
It's almost like the self-driving car of consulting, fascinating potential, but hugely disruptive to the existing players if it really takes hold.
That's a pretty good analogy, actually.
Yeah.
It's something they have to navigate very carefully, adopting AI themselves while also defending against its potential to replace some of their services.
Fascinating. Now, when we consider the impact of macroeconomic factors, how do things like high inflation and rising interest rates typically affect a business like Accenture?
It's a bit nuanced. High inflation can have a mixed impact. On one hand, it might reduce clients' discretionary spending on big new projects. But on the other hand, it often increases client demand for efficiency consulting, cost takeout projects, things Accenture is very good at delivering.
So a potential offset there.
Right. Rising interest rates, however, are generally seen as negative. Higher borrowing costs can cause clients to delay large debt-financed transformation projects, which can slow down Accenture's growth in certain areas.
What's truly unique about Accenture, though, according to the report, is its macroeconomic hedge. Can you explain that?
Yeah, it refers to their broad service portfolio. It allows them to pivot their sales focus depending on the economic climate. During boom times, they sell growth and transformation. During downturns or periods of uncertainty, they can pivot to selling efficiency, cost reduction, and operational resilience. This ability to shift focus helps smooth out their revenue volatility compared to more narrowly focused firms.
So they're kind of like the Swiss Army knife of consulting. They have a tool for almost every economic climate. Does this truly make them recession-proof, though, or maybe just recession-resistant?
I definitely say recession-resistant is the more accurate term. They're certainly not immune to major economic downturns, but their diversified offerings and ability to pivot provide a much stronger buffer than many other companies.
Okay. The report also specifically mentions the potential impact of the U.S.-imposed tariffs of 2025. How might those affect Accenture?
Well, professional services themselves aren't usually directly tariffed, but the impact is indirect. If tariffs put financial strain on Accenture's clients, particularly in manufacturing or global trade sectors, those clients might delay or scale back consulting projects as a result.
So an indirect negative hit.
Potentially. But interestingly, this kind of disruption also creates an offsetting opportunity. The report points out that trade tensions and supply chain shifts create significant new demand for specialized consulting services around supply chain reconfiguration, navigating new trade compliance rules, reshoring analysis, etc. So what looks like a threat on one side can actually turn into a new counter-cyclical revenue stream on the other.
Turning challenges into consulting opportunities. That makes sense for them. Okay, finally we arrive at Chapter 7, Conclusion. Expert, let's try to synthesize all these findings. What are the key bullish points and the key bearish points that investors should really weigh?
Okay, let's summarize the key bullish points that come through strongly in the analysis. First, Accenture clearly has a wide and durable economic moat, built on its brand, scale, switching costs, and integrated model. It's incredibly sticky. Second, they possess exceptional financial strength, that conservative balance sheet, consistent free cash flow generation. Third, their capital allocation approach is disciplined and shareholder-friendly, shown by those consistent dividend hikes and buybacks. And crucially, fourth, they are strategically positioning themselves for what could be a generational opportunity in AI with that big reorganization. That's the core bull thesis.
Right. A high-quality leader pivoting towards a massive opportunity. However, we must also carefully consider the key bearish points. What are the main concerns?
On the bearish side, first, there's the undeniable decelerating growth and, more importantly, the weakening bookings figures recently. Those are tangible near-term concerns causing market anxiety right now. Second, that concerning multi-year decline in return on invested capital, the ROIC, that's a significant yellow flag that really questions their capital efficiency, especially with all the M&A.
Yeah, that ROIC point stood out.
Third, there's significant execution risk associated with their massive large-scale AI reorganization. Pivoting a company of this size is incredibly complex and carries inherent risks. Will it work as planned? And finally, the valuation. While it's trading at a discount to its history and peers, it isn't necessarily obviously cheap when you factor in those near-term growth headwinds and the execution risks. The discount might be justified for now.
Okay, a balanced set of pros and cons. And just to reiterate the valuation summary from the educational DCF.
Right. Based on that specific educational DCF analysis, using those stated assumptions we discussed earlier, the estimated intrinsic value range for Accenture came out between $310 and $335 per share.
So what does this all mean for you, the learner, looking at this? At the analysis date price of $284.82, Accenture shares appear to be trading at, let's say, a modest discount to that estimated intrinsic value range.
Yeah, that suggests the market seems to have fully priced in those near-term headwinds, the slowing bookings, the client caution. But it may not be giving full credit yet to the long-term AI potential that could genuinely reignite growth if they execute well. There seems to be a disconnect between near-term sentiment and long-term possibility.
So for a long-term, business-focused investor, acquiring a stake in a high-quality industry leader like Accenture during a period of cyclical weakness and market skepticism, well, that can be an attractive strategy historically. Get quality on sale, so to speak.
It can be.
However, the ultimate investment outcome for Accenture from here will likely hinge critically on management's ability to successfully navigate this ambitious AI transformation and actually reignite that growth engine. Is this a moment of strategic brilliance where they expertly pivot to capture the future, or is it maybe a high-stakes gamble that could stumble under its own complexity and weight? That's really the central question we'll leave you to ponder.
A lot riding on execution.
We hope you enjoyed this deep dive into Accenture. If you found these insights valuable, please remember to like this video and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And remember, for just €4.99 a month, our members get priority deep dives on tickers you suggest in the comments. Plus, you get additional and exclusive S&P 500 stock videos every single day.
And a special note just for our members, please do add your stock suggestions for future deep dives in the comments section below for priority consideration. We really value your input and want to cover the companies you're most interested in.
As always, please remember that this analysis was generated by an AI system purely for educational and informational purposes. It should absolutely not be considered financial advice.
That's right. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions based on anything you hear here. Your own due diligence is absolutely paramount.